we are almost about an hour away from the opening bell on Wall Street for Friday. The Dow Industrials are down 35, but the Nasdaq's up 51. Futures indicating a mixed opening. Markets bracing for some heavy positioning flows. Probably have some real volatility given more than $7 trillion in options are expiring today. One of the largest so-called quadruple witching events on record. Despite the recent volatility, markets have been seeing a strong year. All three major indices posting double-digit gains in 2025. Look at the Nasdaq up 19%, the S&P up 15%, the Dow Industrials up 12.7%. Year to date, driven largely by the AI-led rally in tech. Now, Wall Street analysts are projecting the S&P 500 to climb into 2026. They've got targets ranging from roughly 7,100 to 8,000, driven by strong earnings and expectations for lower interest rates. Joining me now is the president of MacroMavens, Stephanie Pomboy. Stephanie, good to see you. Thank you so much for being here. And you've been warning that corporate balance sheets may not be as strong as investors believe. What do you mean? What are the biggest credit risks that you're looking at?
Well, I think that it's no secret that there's a dramatic bifurcation in the corporate sector, just like there is in the consumer sector, where you've got the top end that's doing very well, is flush with cash, and the bottom that's really laden with debt. And they're trying to roll that debt at stubbornly high interest rates. And you and I have talked about this for a long time, and the numbers really haven't changed. And that is that we're staring down the barrel of over $1 trillion in corporate debt that rolls next year. And despite the Fed's, 6 rate cuts since 2024, we have seen no relief in terms of corporate borrowing costs. Just since the Fed started cutting rates in September, investment grade and junk bond yields are marginally higher than they were. So this is going to become a major problem for the low end of the corporate sector, just like it has been for the low end of the consumer sector. And I think what's kind of interesting to look at is the fierce competition for capital that these corporations are going to face from the federal government as we come into 2026, because the government has to roll $10.3 trillion in treasuries next year. $10.3 trillion in treasury debt comes due next year that needs to roll. So there's going to be a real tough fight for capital next year. And I think the potential for some dislocations in the credit market cannot be dismissed. And so that would be my chief concern about those forecasts for, strong earnings and resilient stock prices next year.
Well, Stephanie, any thoughts on what happened overnight in Japan? Because interest rates this morning are reacting after the Bank of Japan raised interest rates to a 30-year high. You've mentioned the bond market is headed for much stiffer competition for capital between public and private borrowers.
Yeah. Well, I think Japan is a perfect window into where we could be headed. Japan has been leading sort of the entire G7, which are, if I can paint with one broad brush, indebted, massively indebted, and decrepit in terms of their demographics. They have these massive obligations to an aging population that they cannot fund, and that's been swelling debt. And now what we're seeing in Japan is the consequences of allowing this debt to go out of control, and it's sending their borrowing costs higher. And, they have been printing money basically to try to monetize that debt, and that created inflation. And now they're in the problem of trying to snuff out the inflation that they created in the process of trying to address this completely untenable problem. So sadly, I think it's sort of a microcosm of or macrocosm of where we're headed if we don't get this right. And I heard you with Mohamed El-Erian earlier, where he outlined, the probabilities around the economic outcomes next year, and acknowledged that, threading the needle and having this work out just perfectly, given all of these issues, is pretty low. And yet the markets appear to be pricing in precisely that perfect outcome. Yeah. So as ever, I like to identify the risks to the consensus expectation. So I sound like a negative Nancy, but I'm just trying to identify where the consensus could possibly go wrong. And I think this is the major issue, is the interest rate outlook.
Yeah, I mean, there's a potential that the Fed makes a mistake, right? I mean, the president has been weighing all of his choices for the next chairman of the Fed. He said that he's talking with 3 or 4 candidates. The president signaled he wants a more aggressive approach to rate cuts, obviously. He wants to bring down the cost of a mortgage as well. He praised Fed governors Christopher Waller and Mickey Bowman yesterday without confirming finalists. Here's what he said. Watch this.
How many people are you interviewing for the Fed chairman, and what did you think of Chris Waller?
I think he's great, and he's a fantastic man. I met him yesterday. Again.
So how many people are you looking at?
We're talking to 3 or 4. I think every one of them would be a good choice, honestly.
Michelle Bowman?
We'll be making a decision pretty quick.
Is Michelle Bowman on that list, too?
She's fantastic. She's a fantastic person.
When do you expect to make your announcement about the new Fed chair, sir? Before the end of the year?
Over the next couple of weeks. I mean, I don't know before the end of the year, but pretty soon.
Well, the president is zeroing in on the finalists, which, as you know, are Kevin Hassett and Kevin Warsh. How do those names differ in terms of your policy expectations? By the way, the president is teasing a 1 o'clock announcement today. He's supposed to make an announcement today at 1 o'clock. We don't know what it is. I don't know that it's the Fed announcement. Could be, but we'll see. But tell us your expectations, depending on who it is and how things change.
Well, not to be overly snide about it, but I don't really believe it matters. You know, we're talking about gradations of dovishness, ideally. You know, this is what the president wants to see someone who's going to come in and cut rates as dramatically as possible on day one. And I think, as pointed out, you know, as I pointed out earlier, we've had 6 rate cuts to no avail. So I continue to pound the table that the Fed funds lever is broken. It's the balance sheet that matters. And in that regard, as much as I hate to say anything favorable about Powell, he actually is expanding the balance sheet again, which is the thing that obviously is the only lever that's working. So I think this fixation on who's going to cut rates the most sort of misses the point. So far, these rate cuts have been ineffective. And I think the point is that the balance sheet is the only tool that the Fed can use to really inject stimulus into this economy and the markets. And I fully expect that they will begin to expand their purchases beyond just Treasury bills over the course of 2026, regardless of who the president chooses to run the board.
You know, we were just talking with Jason Smith, and he was walking through his expectations in terms of the impact of the big, beautiful bill. The Lindsay Group this morning writes tailwinds for 2026. And Larry Lindsay writes, by the Joint Committee on Taxation scoring, 4 significant new provisions will provide an estimated $70 billion in tax relief next year, or more than 0.3% of disposable personal income. Excluding overtime pay from income tax will mean an extra $31 billion to consumers. Excluding up to $25,000 in tips from income tax will mean an extra $9.5 billion, and the additional standard deduction for seniors is worth $23.1 billion. Excluding auto loan interest tax will be worth $6 billion. That's a lot of money, Stephanie. Do you think that's going to be a tailwind to the economy in the first half?
I think it will absolutely be a tailwind, and I'm very bullish on that. My concern is it sufficient to offset the burden of higher interest expense, which doesn't seem to be going away? And the numbers on the interest expense increases are much larger than what we're talking about in terms of $70 billion. You know, they're in the hundreds of billions across the consumer and corporate sector. So that's a huge issue. And it's not for nothing that the president is pushing so hard for rate cuts, because he sees that. My concern is that getting the Fed to cut rates actually won't solve the problem, and we've got to enlist some more aggressive tools to achieve that end.
All right. Well, we remain waiting on the 2 major decisions that we're waiting on, and that is the Supreme Court and its decision on President Trump's tariffs in an emergency, and, of course, the president's pick for the chairman of the Federal Reserve. Scott Bessent told me we're getting both decisions early January. We'll see what the 1 p.m. announcement from President Trump is today. Stephanie, good to see you. Merry Christmas, my friend, and we will see you soon. Thank you so much, Stephanie.
Merry Christmas to you, Maria. Thanks for everything.
Thank you so much. Thank you.